All right. Good afternoon, everyone. Thank you for joining us for the Metalla Royalty and Streaming Corporate Update. My name is Kristina Pillon, Investor Relations for Metalla. I'm pleased to introduce President, CEO, and Director Brett Heath, who will be speaking on behalf of Metalla today. Also with us today from the Metalla team is Drew Clark, Vice President of Corporate Development, Sunny Sara, Corporate Development Associate, E.B. Tucker, Non-Executive Director and shareholder of the company. If you have any questions, please submit them by clicking the Q&A icon at the bottom of your screen. And following the presentation, we will address as many as time permits. And for a digital copy of the presentation to which Brett is about to speak, please visit our website at www.metallaroyalty.com, or you can email me directly at info@metallaroyalty.com. Brett, over to you.
Thank you, Kristina, for that wonderful introduction, and thank you all for joining us here today at our first ever company webinar. One of my favorite things to do, as we've been building this company, is to talk to shareholders. And unfortunately, with the situation in the COVID environment and travel restrictions, I'm not able to do that. And it's one of my favorite things. We're a shareholder-based company. We are shareholders. We think like shareholders. More importantly, we act like shareholders. And so it's important for us to have that direct line of communication to you, the shareholders, the ones that are the lifeblood of this company, and the ones that we're working hard, along with us to make this a big success. And we've got quite a bit there, so we're excited to do this. And if it's a great turnout and we get some good feedback, we're gonna hope to make this more of a regular type of event, just to keep everyone posted on the developments of the business and how we're thinking about things and what we're seeing in the markets, and all of these benefits that you typically get when you go to a mining conference, or if you get to spend time, if we're marketing through different cities here and there, that you get those advantages to really kind of be in line and in tune with the business, which is an important thing as a shareholder and investor in a company. So what we're going to do today is I'm going to give a brief overview of just the general kind of strategy and really what we're focusing on today. We're going to do a quick highlight of the recent transactions that we've accomplished in 2020. This has been probably, I think this will be one of our most active years ever since inception. And so we're going to kind of run through the highlights. We're seeing just a tremendous amount of great things that are happening on all these projects. And so we're not going to be able to hit them all today, but we're just going to try to get the ones that are most recent, that we probably haven't had a chance to discuss, given we're a bit disadvantaged with everything that's going on this year. And then at the end, we are going to talk about kind of what's next for the next 12 months, 24 months, kind of where we see everything going in regards to the outlook of the company. And the grand finale, if you can hang in there, is going to be the E.B. Tucker Global Economic Outlook and gold price. So make sure to hang on to all the way to the end. He's got some great things for you there. You're not going to want to miss. And then we'll be doing some Q&A. So we're going to kind of try to target about 20-30 minutes through this, and another kind of 20-30 minutes through the Q&A. And if you have any questions, there is a button at the bottom of your screen here on Zoom, and it says Q&A. And please type those in as they come to mind. And at the end of this, we will try to get through as many as we can. And it's always a good way, because if you've got that question, there's probably another 10 or 15 or a lot more shareholders that have that same question. So please type in those questions as you get them, or as they come to mind, and we'll try to work our way through. So Anyway, kicking off here, I will be making some forward-looking statements. There will be forward-looking statements made through the rest of the company, so please understand those risks, as you've probably heard before. As we dive into this, one of the things, or really, as we look at this business, as we look to build this business, I think most of you, if you've been an investor for a while, you've been following us for a while, you'll have a pretty good idea of kind of how we operate. But just to kind of summarize, we focus on a few kind of key things while we transact on any different deal. And what that is high quality, accretive growth, and to make sure that that growth has a lot of upside. And so that's important for every single one of these deals that we do. This sector has become just fiercely competitive. I mean, I thought it was competitive when we started the business back in 2016. I never would have thought that there would be this many royalty companies that exist today in 2020 back then, but there is. And in order to generate the high quality creative growth with upside, you have to have that laser focused business model. And as an investor, this is one of the most important things that you need to understand when you're investing in any royalty companies, because there's a lot of great royalty companies. It's just, these assets are so phenomenal. A perpetual right that's non-dilutive at the asset level, into perpetuity, that gives you this top line cash flow. I mean, the asset itself is so phenomenal that if you can make good acquisitions on good projects with high quality counterparties and make sure they're accretive, and accretive means that when we buy these assets, when we issue shares, or when we raise capital, the value of what we're buying is worth more to the shareholders than what we paid for it. That is the bare bones of it. That's what we're trying to do. And as we do that, that adds value. It adds value to the other asset. It adds values and raises the public market premiums in this business. And so, as the company grows, it becomes this just this incredible tool that allows investors to speculate on gold and silver. That's what we're doing here today. That's why we created this company, was because we wanted to have an investment vehicle that captured everything that we wanted, as an investor. And so, we set out to build that, and every single deal that we do, we focus on that. Now, that all sounds easy, but it's actually extremely difficult. And so if you don't have that laser focused business model, if you don't have that significant competitive advantage, then it's very difficult to be able to do these types of deals in this sector. And so Metalla, as we set out, the opportunity that we saw was to focus on the existing royalties. These are all the royalties that exist in the world. They've been originated sometime before. This market is massive. It's huge. It's much, much bigger than even our peers appreciate. And I think a lot of the smaller peers are starting to appreciate, as we've seen a lot more companies come into the sector. But the difference here is that the existing market is not like the traditional market, because once these royalties are gone, they're gone. And so, although there still is a lot of them there to do, and I think that Metalla can do and can continue on this growth profile for the next 3, 4, 5 years to be a much bigger company. The benefit that the shareholders need to understand of what they get with Metalla is the high quality assets, because we have a significant first mover advantage where we were out there building relationships with these holders. We were scouting the world for these existing royalties. We were spending the time to build up this portfolio, or this pipeline. As the portfolio was going, but we built up this pipeline even before we started this company. And so that has given us the advantage to pick out the highest quality assets. And what we're going to do is we're going to continue to pick out these high quality assets as the business grows. The difference is that we're going to be scaling into bigger assets that have more of an impact, that allow us to scale, the business even further. And we feel confident that those are available, those are in front of us, and that we will be able to execute on these. A few of the highlights over the last 4 years, and one of the things that you should understand as an investor is, it's incredibly difficult when you have so many assets to not have impairments. Now, impairments are essentially write-downs on assets that you previously bought, and I'm proud to say to date that over the first little over 4 years of our business, we still have not had an impairment. This is something that I think almost no other royalty company has done since inception. Even the big, most successful royalty companies, I mean, at some point we will get them. We try, if you've got 100, 200 assets, inevitably in the mining business, it happens. But, we try to do our best to pick the right assets, the ones that we know are going to experience a significant amount of growth. And that's also a big benefit that we have as a company. When we're buying royalties that are existing, we can target these assets at specific stages when we know they're going to increase in value. And if you think about the traditional model of being a capital provider to the mining companies to build a mine in exchange for royalty, they're not doing this. They're not able to do this because everything within that asset has been drilled out to justify that CapEx so they can build the mine. And once they get that capital, they're just trying to put that mine into production, which is also a very difficult thing to do. So we've been able to target royalties on some of the largest counterparties in the world. The Barricks, the Newmonts, the Kirkland Lakes, the St. Barbaras, the Pan American Silvers. Just the quality is so significantly weighted towards the majors for a small company. It's something that is truly unique with our strategy, that allows us to be able to give investors this extremely high growth vehicle with the risk. I mean, inevitably, every royalty and streaming company, the risk goes right back to the assets and the counterparties. And what we've been able to do so far is we've been able to put together a phenomenal portfolio of some of the strongest counterparties. We're seeing huge increases in reserves and resources on these projects, which is something very important to understand. So not only do you still get to maintain that upside, but when we know that there's a big mining company that's going to be moving one of these assets into the mine plan, we know they're going to be drilling it. We know they're going to be spending millions and millions, and for our portfolio combined, it's hundreds of millions of dollars that these companies are spending for your benefit. They're drilling, they're finding new ounces, they're making discoveries, they're advancing these projects, they're putting up the capital to build them. All of these benefits, all of this value flows through right back to the shareholders as this business captures all of that NAV. It captures all of that value and it brings it forward. And by us executing on our model, by us being disciplined and making sure that we're buying stuff that's accretive, that's high quality, the market has slowly and steadily continued to give us very consistent increase in our market multiples, which is something that we're also very proud of, because in the beginning, no one even knew what we were doing. Everyone couldn't really understand. Now that we've got 51 royalties, the portfolio is really coming together. The vision's really coming together. People are starting to be able to extrapolate this forward. And that's what we've seen since the very beginning. That's what's so powerful on where we see this business going forward. And so I'll touch on that a little bit later here, but I want to pass it off to Drew and Sunny. Drew and Sunny are our corporate development team based out of Toronto, and they're going to quickly run you through some of the highlights on the recent transactions and a few other things that they see relevant for our investors today. So Drew and Sunny, off to you.
All right, great. Brett, you already took some of my points, so I'll be a little bit shorter. But I think the one thing that's really worth pointing out, just before we get into it, is a lot of people ask with all the new entrants and with gold prices where they are, how are we competing with all these guys that are giving capital to junior miners? And that's just something we simply don't do. Not only is it a bad idea from a counterparty perspective, but typically you see guys paying valuations that imply like it's an operating royalty operated by a major for a tier 2 or tier 3 asset. So we've really been trying to focus on these third-party royalties, and it's making our business busier than ever. And not only have we been, have these long-dated options that we've got in the hopper from day one, we've also got guys that are now seeing the gold price move and going, you know what, now's my time to call Brett, call Drew, call Sonny, and get a position in a meaningful vehicle that'll be a good custodian for the royalty. And that happened with the Wharf transaction, but we could talk about that later. So we already talked about this being one of the busiest years we've done. We've had 5 deals so far, so about $90 million worth of transactions. And we're pretty confident we can get at least one more through by Christmas. Quick overview of the 5 transactions before I hand a couple of the more geology related ones over to Sonny. We brought in cash flow from some top operators in the business, one from Wharf and one from Karora, which is being run by an exceptional operational turnaround team. We've also complemented our portfolio with exposure to world-class ore bodies in Cortez and Fosterville and Nueva Union that we're really excited about. So with that, I'm gonna hand it over to Sonny to talk about the Nueva Union transaction.
Thanks, Drew. So we began the year by acquiring a 2% gold royalty on the humongous Nueva Union joint venture project, which is operated by Numa and Teck Resources. It's a Chilean porphyry with a copper gold portion. And we came into this with a unique structure where we took the gold potential and Nova Royalty took the copper. The total purchase price was about $8 million with only $3 million upfront. And with acquiring this royalty, we saw a humongous potential to have a very large copper gold porphyry with upwards of 14-year mine life. Now, we know that Numa and Teck are investing upwards of $150 million into the project for exploration in the coming years. And they're close to finishing a feasibility study. As they continue drilling and exploring, we expect this to get a lot larger. Going forward, we acquired the Idaho Resources Corporation. Now, this is 2 royalties. One is operated by Nevada Gold Mines, and this is about 19,000 hectares on the majestic Cortez Trend. And the land operated by Nevada Gold Mines is on strike with the 10 million ounce Gold Rush deposit. Now, we were inspired by the exploration potential in this trend. Little has been drilled east of Gold Rush, and the reason for that was because they had made the discovery at 4 Miles. So we saw that, there's a lot of exploration potential here. The stratigraphy and the structures are all there. There could potentially be a lot more over here, and southern portion of Gold Rush does extend onto the claims. So we're excited to see what will happen once Nevada Gold Mines starts drilling there. And we've also already noticed that Nevada Gold Mines has been drilling there with, they had already completed about 3 holes east of the Gold Rush structure, and they found alteration at depth, and they also found anomalous gold. So we're excited to see what will happen as they continue with their exploration program. As a part of this transaction that we spent $4 million on evenly between cash and shares, we also got a 1.5% royalty on New Legacy Gold's land package. Now, this company, New Legacy Gold, is full of ex-Barrick employees, and they had outlined a near surface oxide deposit, and they decided to change their strategy to focus on the Rift anticline target, which looks like a very similar potential prospect to Barrick's Gold Rush at depth. Now, the team in place, they've outlined a target, and they'll be beginning drilling within the next few weeks, and we're very excited to see what happens there. So potentially there could be some holes coming out of that project by the end of the year. Shortly after that, we had acquired my favorite royalty ever, a royalty on Fosterville. Now, this is a 2.5% royalty on Kirkland Lake's flagship asset. And we saw the opportunity to acquire royalty on one of the most successful operating mine success stories in the industry. And Kirkland Lake is spending upwards of $80 million US on exploration on the project, and they currently have more than 9 rigs running. And Kirkland Lake is currently mining within the Harrier structure near our royalty grounds, and development drifting is ongoing in the structure as well. Now, we're really excited that Kirkland Lake will be spending a lot of money on getting more resources in the mine and eventually another Swan. And it looks like the geology does change once they get deeper than 800 meters depth. And it looks like the Harrier zone is also exhibiting similar changes and increased visible gold incidence as they drill deeper at depth. And now I'll let Drew focus on the Wharf transaction.
Okay, so rounding out the transaction this year that have already happened since January, we did the Wharf deal. This is by far the most complicated deal, I'd say, in the history of the company, definitely the calendar year. We purchased a 1.3875% royalty, took 0.3875 and assigned that to Core Mining, while at the same time completing what ended up being a $21 million US secondary offering, all at the same time. Weekends were lost, sleep was given up by the entire management team, but it was a really big deal for us because not only did we show liquidity for people to partner with us, really proving out our model, but we also brought in a cash flowing asset, which is supplementing our awesome development portfolio. I mean, it was obviously had a lot of complicated and moving parts to it, but at the end of the day, we picked up an operating mine that's been going since 1984 from Coeur that was previously part of the Goldcorp camp, that's going to produce cash flow, meaningful cash flow, probably at least $2 million US a year for the next 7-8 years. So it really bolstered our portfolio while we wait for some of these other things to come online. The second cash flowing asset that we brought in was actually the most recent deal, and one we probably haven't really had a chance to talk too much about, was the Higginsville price participation royalty. There's some complicated nuances of it, but at the end of the day, what really needs to be driven home here is we're looking at about $700,000 a quarter in cash flow once this thing gets up and running, and it's giving a tremendous amount of upside to what's basically never been drilled with any meaningful exploration budget over the previous decade. For those who don't know, Karora Resources is under the custody of Paul Hewitt and Graham Sloan that are doing a great job pulling ounces out at a lot of margin. And we wanted exposure to it however we could. So that's sort of a short-term cash flow plug, as we mentioned earlier. It was really going to bridge the gap before some of our more meaningful development assets come online. So that kind of rounds out the year. And like I said before, we're going to bring a couple more in before Christmas.
Brett, unmute yourself.
Thanks, Drew. And I think you hit on a couple of good points here in regards to the cash flow of the company. And although I strongly believe that the value of the company is in the NAV, and that's where kind of the market has put us, and that's where we've seen investors look at it from that perspective. It is important to have a little bit of cash flow, and that was something that we wanted to address this year. Our model does work for cash flowing assets. It does work for assets that produce and can throw off a ton of cash. And I think more of those transactions are likely to be in the future. And a lot of that is going to be a function of really the scale of the company. Because some of the big deals on our list are the entire size of the company. And so a year ago, even 2 years, or even more 2 years ago, a lot of these transactions, we weren't in a position to transact on because the pro forma ownership of the company would just be too far out of whack in regards to the holders of these phenomenal assets that have been stuck really in the existing market for decades. And our track record, our strategy, and our business, I think, will continue to allow and surprise the market on what we're able to do here. So, I think the next 12, 24 months are going to be very exciting. Stay tuned as all you shareholders. We've been working very hard to deliver a number of accretive deals here this year, along with significant milestones in the company. Trading on the New York Stock Exchange was a huge one in January. It opened up the world to capital flows. That's another very important thing as a company. It was a goal we had in the very beginning. It seemed like a massive goal that would be very difficult to hit given the starting point of where we were at, and we were able to get it done in just over 3 years. And another catalyst that I think we will see come the first half of 2021, calendar 2021, is potential ETF and index inclusion. Keep an eye on this, because most of these ETFs and indexes require about 2 consecutive quarters of meeting these requirements before they include you into these ETFs. And Metalla, as of today, we feel confident that we're likely, we've made all these requirements for kind of calendar Q3, and we think we'll do the same in calendar Q4. And so we think that there's a high probability that we may start to see a bit more of these ETF and index inclusions, which is going to increase the volume a lot more. It's going to create a large amount of demand in the public markets, and really help scale the company to a different level, give us more access to bigger institutions, more capital, etc. So lots of great things coming over the next 12 to 24 months, and we're going to continue to crank and get as many of these transactions as we can, while the market is still there. And the one last thing that I will leave you with is that in regards to the business environment, and we've already seen with a lot of the big royalty companies, a lot of the major royalty companies have already publicly stated that the deals have become significantly harder to do because the issuers, the mining companies, have access to capital. We saw a lot of bought deals go up for even some of the, I would say, marginal or lower quality junior companies as gold was pushing up to 2,000. So there has been some equity that has disrupted the business or the traditional model. But what Metalla is seeing is we're seeing more of an urgency. We're seeing an urgency from these third-party holders that want to get positioned before this cycle takes off, really into this next phase. I think we're at the beginning of it, but what I'll do is I'm going to hand it off to Evie to give you some insight on where we're at on the gold price and the macro environment to better handle that situation.
Thanks, Brett, and great job with that. And everybody, if you're anything like me, sometimes when Brett and Drew and Sonny these guys are so smart and they're talking, it sounds like Charlie Brown's mom to me, because there's so many technical pieces to the business that are so complicated, and they do such a great job. But I want to try to help you see the business the way that I see it. And if you read my book, Why Gold, Why Now, you know that what I was really trying to do in the book is to share with you why I've invested so much money in this company. I've continued to buy stock even this week. I've just consistently bought stock. It's not been that it's cheap sometimes, it's expensive sometimes. I've put a significant amount of money into this company for a very specific reason. I tried to share that with you in my book. So let me take what these guys have said and break it down for you more simply. We're coming up on the 4th anniversary of the company. So December 1st, 2016, since that time, Metalla is up 690%. 690%. Gold is up 61%. So Metalla has performed more than 10 times more than gold. Now, how is that possible? I'll tell you. And just so you know, I read all your comments on the message boards. I see all these things that you say when you want the company to have more cash flow and you're looking at the P&L of the company. And it's really hard for me to read that because I adamantly disagree with people that always want the company to generate more cash flow. And let me share with you why. If we had been producing ounces back in 2016 and burning up those ounces before gold is 61% higher, those ounces are gone. We have to go back out in the market and buy them, or we have to have one of the mining companies that we have a royalty on their asset drilling and finding more ounces. So you burn those ounces up, they're gone. I'd much rather have those ounces coming next year or the next year or the next year, so that as the gold price rises, I'm getting more credit for those ounces today. And that's what we have going on with Metalla now. Back in 2016, we had, I think, 3 royalties. It's not very many. Now we have, what, 51? I mean, that number, has grown and grown and grown, and I'm optimistic it's going to keep growing, because what happens is the company is in a better state today than it was back in 2016, before you've had this 690% run. And I don't know if you can see, but here's the chart of Metalla. It's pulled back so much. This is, in my opinion, a fantastic place to take the next ride. I mean, we are just getting started. Now, for context, since that day in 2016, when Metalla's up 690%, Apple's up 312%. So Metalla's performed twice as well as Apple. Amazon's up 321%. Pretty good. That's pretty good, but not as good as Metalla. Now, the reason why that matters today is the company has a base, it has a pipeline of deals, it has a team. You've heard from the team. I'm in contact with these guys all the time. In fact, they send me more information than I even care to read. And they are so active in bringing in more royalties. This is not a company that's up to a certain size and now it's going to sit around in an office in Toronto or something. This company is built to capture what I wrote about in this book, which is much higher gold prices. Now, let's get into that for a minute, just to keep things very simple. The value of all the gold that's ever been mined in the history of the world, okay, that's gold teeth, gold chains, wedding gifts, everything, it's $12 trillion. $12 trillion, that's every ounce of gold. That's according to the World Gold Council's number. I think they're pretty accurate. They do a good job. Okay. The US budget this year, okay, counting the deficit spending, you're going to be over $7 trillion. So you're going to be 61% of the value of all the gold mined since people were walking around barefoot, thousands of years ago. That's all the gold in the history of mankind. 61% this year. And what happened yesterday? Just because they said no more $2.5 trillion stimulus giveaway, which is really just financial theft, okay, from the future, as we all know, and the market crashes. Believe me, the spending is going to go up, 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 up. Okay, the debt's going to double under Trump. It started out at about 18 trillion when he was elected in 2016. It's on the way to 36 trillion. Okay, why does that matter? It matters because this is the driver of the gold price. So forget about the day in, day out. The gold price is going to 2,500 bucks. The way I see it, the silver price is going to 40. It's going to happen very quickly. It's going to be a situation where people wake up and they say, wait a minute, I've got to have something to protect my wealth. It's a war against wealth. And very few people know it. If you're watching this webinar, you know it. So you have gold for stability for your wealth, and you have Metalla for the upside. All the value of that gold in the ground is what you get credit for as the gold price rises. So next time you go on the message board and say, I wish they had more cash flow, think about it. When you burn up those ounces at 1,800, you'd rather burn those ounces up at 2,500. Okay, you get a much bigger bang for your buck. And here's where we stand today before I turn it back to these guys. 1887 gold, let's go to 2,500 on that. It's going to happen quickly. $24 silver, let's go to 40 bucks on that. And you take a look at those 51 royalties and those thousands and thousands of ounces of gold in the ground. And you ask yourself, what's the value of this company going to be at $2,500? A lot higher than today. And so we're in a place where you look at Metalla and you say, I can't buy it now. It's gone up too much. It's just getting started. So with that, let me turn it back to Brett. I know we have a lot of questions. and hopefully we can get through some of them.
Thank you, EB. That was a great update. I'm sure that all the shareholders and investors were very pleased to get that special update and report. So we'll go through the Q&A. I do see we've got about 23 questions, and I think we should be able to get through most of them here. First question is, can you please update us on the status of the dividends? So just as a recap, we started paying a dividend in January of 2018. And we continued to pay that dividend through May of this year. And a couple things happened this year. Obviously, everyone's well aware of the COVID situation, and we've never seen, in my lifetime, I'm sure, in almost the last, well, definitely my lifetime, but probably the last century, we've never seen a global shutdown across the world of business. This is a new phenomenon that I think we're still waiting to see what the repercussions are going to be. And so what happened because of this was we had first off, our largest producing asset, which was Endeavor, over the last few years of the company, that went on to care and maintenance a bit early. At the same time, our two Pan American silver royalties that were going into production were put on care and maintenance, or really just delayed until Q3 of this year. So that was kind of a reason why that we decided to pause the dividend. What's behind the dividend, or how we think about it, is we want to target up to about 50% of the operating cash flow, and it's not to be looked at as a steady kind of just completely still RBC, I'm owning this for a dividend stock. You're owning the stock for growth. You're owning it for the 60, 70+% compound annual growth rate in the share price that we've been able to generate since our first financing. But we do like to have that direct link back when we do buy an asset, when it does generate that cash, to give some of that cash back to shareholders. And that helps buy and extend the portfolio until we get to a point where half of that cash is more than enough to continue the business in regards to replacing all the reserves that we'd ever be paying out from the royalties that we receive. So since the beginning of the year, since we made that pause, we've acquired the Wharf royalty, as Drew stated earlier, was a cash flowing royalty. It's generating kind of just up to about $2 million US a year. We're just we announced an additional cash flowing asset, which was on the Higginsville participation royalty, and this will be about $2.5 million a year in free cash US. Both those are in US dollars. So what we've done is we've taken kind of the bulk of our production, and now it's a bit more diversified from a cash flow perspective. So we've got 5 producing assets. We've got cash flow coming from a number of different mines, a number of different counterparties. So it's a much stronger position. And what we're going to look to do is look and see as these assets push forward, as the Pan American ones get up to a commercial rate. And, we hope with the assets that we have, that should generate significant free cash for us to reinstate the dividend. But we will wait, just because of this current environment. We're going to kind of see how it plays out and just make sure that there's not another wave of shutdowns after the elections or anything of that nature. Going through some of these other questions here. Where do we see the royalty business in 10 years in comparison to the FANG stocks? I mean, the royalty business is a business that, when you build it, you build it for the future. In regards to the FANG stocks, I mean, I'm not really sure, how it would look in comparison to those. But what I can say is that, I think fast forward as we get further into this gold cycle, we will see some of these big royalty companies start to take the place of what we see in tech. I think tech is fading here. People are going to start to realize, as Evie stated, and as all this starts to play out from an economic perspective, that they're going to need more exposure to gold. And I think that's going to drive a lot more excitement. We're seeing it with the number of shareholders that we have on the Robinhood app. There's different ways to monitor this, and you can see it's got, it's interesting to watch, the amount of shareholders that each company has on it. You can look at, Tesla, it was just off the charts. We're starting to see the gold companies move, which is an interesting part. So
Brett, page 207 of my book, I've got a table that shows that Franco-Nevada, this is as of May, has 26 employees, which means $1 billion in market cap per employee. Amazon only has 1.4 million per employee. So I mean, you look at this question about tech. Okay, I mean, obviously tech's not going away, but my point is, as an investor, you look at how many people it takes to generate $1 billion in market cap at Amazon. It's crazy. And same thing with Facebook and with Apple. The royalty companies generate more market value per employee than any other business in the whole world. If there's a business that generates more, send us an email, because I've not found it. And believe me, I've looked. So I think as we get into a time where there's more labor issues, there's more problems with how much does it take to generate revenue? How much effort does it take for the business to generate revenue? I think sometimes people give tech a little bit more credit than it really deserves on paper. The royalty business is lean, it's efficient, it's low overhead. You don't have the human resources problems that you have with bigger businesses. And so I think as you get into a time where those things matter, eyes come on to this business, you could see the valuation of the entire sector really shoot up.
Yes, exactly. So thank you for that. Moving on here, we've got a question on M&A. Do you consider Metalla to be a takeover target? Does the company look to take over other companies, and how do you present a hostile takeover? So I think inevitably Metalla will end up being a takeover candidate. I don't think we are there quite yet. As we continue to execute and as our portfolio continues to mature, we are going to have all of the specific things that the big companies are looking for. And a lot of the operators are, like I said, very high quality. We've got a number of projects that have potential to be cornerstone assets. So I do believe that as we continue to grow the company, that we will have, potential kind of takeover, a premium, if you will, in the share price. And I think particularly the window of which the major royalty companies start to look at that is when your company kind of gets between about a 500 million and $1 billion market cap. That seems to be their sweet spot. You'll notice that we're just under that right now. But I don't think we're going to be under that for very long. So, in regards to Metalla taking over other companies, I mean, most of the smaller royalty companies that are smaller than us, a lot of those assets are assets that we've looked at and kind of passed on. I believe that we are able to acquire, much higher quality assets at attractive prices just within our pipeline. So it's not something that we're looking at really at all at this point. Other than, a company that just has maybe like a one-off asset, but we kind of look at that as more of a royalty transaction. And in regards to preventing hostile takeovers, the best thing you can do to prevent hostile takeovers is make sure that your share structure is diversified. And we've got one of the highest floats in the sector. We've got volume and liquidity that is more than royalty companies that are 2, 3, 4, 5 times our size. So I think we're very, very safe there. It would be very, very difficult. And on top of all that, we put specific provisions in all of the agreements with our big shareholders to give us kind of control over that process. And I think that if there was ever any companies that were, sniffing around in regards to what the options are, they would quickly realize that that the easiest way is to come through the front door.
And one thing I'd add to that quickly is, sorry to cut you off here, Brett, is the disparity in terms of the valuation on price and NAV basis between the intermediates, call it Mavericks, ourselves, Sandstorm, and I guess the Cisco as well, and the big boys being Wheaton and Royal and Franco, of course, is an all-time high. So the ability for the large companies to start looking at these things on an accretive basis is becoming a lot more manageable. Like you could see that path a lot easier. In terms of there being accretion in terms of the valuation multiples between the companies. So if that continues, you might start to see some of these guys get rolled up down the road. But it is something that I think the sector's looking for down the road.
We got another question. How will we maintain our momentum going forward? And again, this goes down to our strategy. We went through this. It's something that gives us just a huge competitive advantage as a first mover, building these relationships with these holders for years, proving out our track record, getting them comfortable with management, getting to a scale of the business where we're able to transact everything that we possibly could do to position ourselves to pick off one of these transformational assets we've done. And I'm confident that we're going to be able to get one or two over the next few years, and it's going to make a very material impact. There are a handful of them, and we think that as we've shown in in the last 4 years, that we've been able to shake loose royalties that have been very tightly held. The Wharf royalty has been held for upwards of 40 years. The Fosterville royalty was held for 30 years. The Nueva Union royalty was held for 30 years by the same owners. A lot of them were the original owners. So it's not like these royalties weren't there for the other companies to buy over the last few decades. It's just no one's approached them with the proposition to have all of the benefits that we can give them. And that's how we can get these assets in the company. That's how we can get them in accretively. And that's how we can continue this momentum going forward. We got a question on the association with Nova Royalty. And we also got another question on regards to my time. If any of the shareholders saw, I personally went on the Nova Royalty board. This is a copper royalty company. It's a copper nickel royalty company only. And so Metalla is gold and silver. One of the most important things for investors to understand when you're investing in a royalty company is invest in a company that gives you exposure to that commodity or to those like commodities that you're after, because giving investors this type of exposure allows these companies to trade at premiums, which is the whole benefit of this business. Now, I've been an advisor to the company. I was, in there originally to, help set that up. And the main reason why we wanted to put together Nova Royalty was because there were so many opportunities that we saw on these copper, gold, mainly development assets, or even producing assets that are out there. I mean, these base metal mines, they have production, they've got mine life sometimes of 20, 30, 40, 50 years. You just don't find that in precious metals, but we didn't want to bring in a big base metal component into our share structure, because that, we believe, would reduce our multiple and have a greater impact. Even if it was a good asset, having that lower multiple across your whole portfolio has a much greater impact to what the share price is. And so we're very, very disciplined to be able to give shareholders pure exposure to gold and silver. And Nova is focused on copper and nickel, which focuses on really the next 100 years of kind of clean energy. But as I said before, I've been an advisor on the company for the last couple of years. My time is not going to change at all. It's simply just kind of a title perspective. So as you see, this year is probably going to be our biggest year ever in Metalla. You can continue to expect that momentum going forward. I've got another question is, how many shares do you think you'll have outstanding within the next few years? I noticed you issued shares to make the deals. Are you afraid of dilution? So one thing that's very important to understand as an investor, particularly in this business, on the TSX venture listed companies, investors are just incredibly terrified and paranoid about dilution. And dilution comes when you issue shares and the asset base doesn't change. If there's an exploration or development company and they're issuing a bunch of stock and they're spending it over here on conferences, and they're going to drill a few holes, they're going to have these companies find some very creative ways to spend your money. But the asset base doesn't change. The asset base does not change. And so that's highly dilutive to you shareholders. The difference with Metalla is that when we issue shares or we raise capital, which we have to raise those shares, we have to issue shares to raise that cash, and we buy assets. We're buying assets that are accretive. So what that means is that if we spend $10 million on an acquisition, oftentimes we're going to get $20 or $30 million of NAV, and then the market gives us a value of upwards of 2 times NAV. So we can take that $10 million of shares that we just issued, and it can reflect sometimes $40, $50, $60 million of value in the market. What does that do? It makes the share price go up. And so as long as we're buying assets that we know are accretive, are going to generate value on a per share basis, we're going to bring those in, and we don't see those as dilution at all. Our business is set up growth by acquisition. So over time, we will have more shares outstanding as we continue to grow, and at some point that may shift when we get much bigger. But as of right now, we're focused on accretive deals that has shown with the rise in the share price. It's also shown, if you follow any of the analysts that cover us, from Cantor to Cormark to Haywood to PI, I believe we've been one of the only companies over the last 4 years that has averaged transactions at a discount to NAV. Most of these assets trade at a premium to NAV, which, again, even if you're buying a great asset, if it's a big premium to NAV, that is dilutive. So it's something to keep track of. But that's
and Brett, just to simplify what you're saying too, everybody learned this word dilution at some point. They went to Investopedia and they learned the word dilution, and then they're on the hunt for dilution. But it's really, really important that dilution and accretion is okay. Dilution is, I issue 1 million shares, I take that money and I buy art for the office and go on a few trips and fly business class to conferences and spend a bunch of money at the hotel, and the money's gone. Okay. Accretion is I can issue stock at 2 times net asset value and buy an asset at 1 times net asset value. As soon as I do that, I automatically raise the value of the whole company, because I took my stock and bought something at a discount. And that's how you generate that growth, is that you're going out there and you're saying, listen, I'm not going to give you 20 million bucks for that. I'm going to give you 15. Somebody else might give you 20, but I'm going to give you 15, and I'm going to give you stock to do it. That's been the whole growth model of the business. So when you see shares issued, the first question is, what did you buy with the stock? Well, if you bought a huge royalty on Core Mining and you paid a really low price for it,
0.72.
Pretty good. And these guys are going to give you all the technical details which are important, but the reality is that you want to go out there with $1 worth of stock, and you want to buy assets at 50 cents on the dollar. That's what you want to do. If you can do that all day long, it's not dilution, it's accretion, which is the opposite. So when you throw that word around, you got to be very careful, because I'm fine with stock issuance to buy really valuable stuff at below market prices.
Thank you. Thank you. Good summary there. I've got a question from a shareholder. It says, why is it hard to find net asset value on your website? Where I would point shareholders, companies, because of the securities laws, are not allowed to state their view of NAV. It needs to be an objective third party. We've got 4 analysts that cover us. So I do recommend reaching out to those banks and those analysts. We can supply the email addresses for these analysts. There's one at Cantor, there's one at Cormark, at Haywood, and PI. These are all banks that cover us in Canada. They've got detailed reports. They not only have it on just our company, but they have the other royalty companies as well. I'd also point to Scotia. Scotia puts out a fantastic kind of monthly market kind of summary of the royalty companies. They compile all the NAVs from all the analysts across the companies. They put out consensus numbers. They go through the different transactions. So that's a great way to understand kind of where the NAV is for the company and kind of in comparison to others. Moving along here. Okay, we got more questions on the dividend. We answered that. We've got a question on Metalla and Nova, and what I would say in regards to investment and kind of what's going on. What I would say is these are 2 completely different investments with 2 completely different objectives, and they have 2 with same strategy to acquire these great assets, but to give investors exposure to 2 completely different themes. So it's important, if you are looking at the different companies, then to understand kind of what your objective is, what you're trying to do, and what you're trying to accomplish in regards to that investment theme, and then look at positioning yourself appropriately for that, and always obviously seek advice from an investment advisor.
But Brett, you'll maybe it's good to let people know that philosophically there's some similarity. I mean, you'll see Nova perform in a very responsible way with the business. You'll see some of the philosophical themes that are behind Metalla. You'll see a different management team. It's not half the time working on a copper royalty, half the time on a gold royalty. Totally separate company for good reason. Because the valuation of the company is totally different from the analyst mind. But when people dig in and look there, some of the behaviors that have been responsible for Metalla's success, they'll see those. You'll see structure, you'll see discipline, you'll see some of the shareholder base be the same. Some of the investors that were very excited about Metalla in the early days are also very excited about Nova for good reason.
So we've got another question. I'm just going to summarize here kind of what are we going to do if the gold and silver price go down? What I'd like to point out is that in the first 2 years of our business, we started in the summer of 2016. The first 2 years of our business was a falling gold and silver price. And it was an absolute just fierce bear market. I think the TSX Venture as an average in the mining sector was down about 60%. The TSX was down about 40. I don't know if those are the exact numbers, but I think they're about ballpark from kind of mid 2016 to mid 2018. And over that period of time, Metalla was able to perform, and it didn't matter what the gold price did at that time, because we were making some very accretive acquisitions, which we covered kind of prior. And so we look to continue to make those accretive acquisitions going forward. And so even in a lower gold price environment, that we still feel like we're going to be able to do enough deals and bring in enough new assets on an accretive basis to be able to generate value. Now, it doesn't mean that we're not going to be trading with the gold price, with the sector. We do, and as we get into more ETFs, we are going to move kind of more consistently with the gold price. And obviously our assets are tied to the gold price, but as a business from a long-term picture, I think we're going to be able to generate value through that. And the perfect example is the biggest company in this sector, which is Franco-Nevada. And, if you're not familiar with that company, I would urge you to just pull up a 13-year chart on Franco-Nevada and see how that stock was able to perform over a number of different cycles. So that's important to see how a royalty company can continue to generate value in bull and bear markets.
Franco went up, Brett, during the 2011, 12, 13, 14, the difficult years. Franco marginally went up. So, I mean, the business is very efficient. It doesn't thrive with a falling gold price, but it doesn't have some of the same problems that a mining company does.
So we've got a question for EB. Will royalties build an increasing source of finance, or will bank finance again become available?
I think this is what I think is going to happen. There's trillions and trillions of dollars that are fixed to future liabilities for pensions, insurance companies, life insurance companies in particular, that are really scratching their head right now and saying, how do we find low risk return? What do we do? 70 basis points for Treasury. For anybody that's not a finance person, that's less than 1%. You can't even keep up with inflation. I mean, the Fed is literally telling you they're going to create 2% inflation, and the Treasury returns 70 basis points. That means you're automatically losing 1.3%. Unprecedented. So I think what's going to happen, and this is a bit of a speculation, but I'm pretty confident this is going to happen, is that a lot of these trillions of dollars are going to start looking into this business and saying, now, wait a second. The mining industry has a bad reputation, but I can put $1 billion into this mine in Nevada, and I can see an 8% return for the next 30 years. I mean, that's 11 times what I'm going to get in the Treasury market, and I can be top on the security list. So I think you're going to see maybe not banks come in and do this, because we used to be banks that did all this. Then came the streaming companies. See, royalty companies really aren't the source of funding for the industry. Royalty companies exist because someone found the asset and had a royalty. It's very different. It's very rare that you initiate a royalty on a project. Usually you initiate a stream. So I think the streaming companies like Silver Wheaton is really the best operator. So I think streaming companies came into existence because the banks got fried in a previous gold downturn. What you're going to see now is royalty companies are not going to be a source of financing. You're going to see streaming companies in play in that business, and you're going to see conventional investors. Capital that you didn't see in that business has got to do something. Where's that money going to go? Stocks? I mean, it's not really a good answer. So I think that's a couple of years from now, you're going to see that type of money come in to the business. And when that happens, it will be a game changer, but it's not going to be the royalty companies that do it.
And we got one more quick question for you on where we or when or where we see negative interest rates.
We're seeing them right now. So here's what you got to do: is you got to say, Jerome Powell, as eloquent as he is telling you he's gonna create 2% inflation. And if you don't think there's 2% inflation, go to the grocery store, go to the used car dealer. Everything is going up in price. This is working right now. There's shortages. One of my family members has a furniture store. He told me recently that he absolutely, in 50 years of being in business, has never seen anything like this. You can't get furniture inventory because of COVID, because of supply disruptions, all these different, everybody knows what I'm talking about. Prices are going up. So you're seeing 2% inflation target. You're probably overshooting that. And at the same time, your rate of return, what's your rate of return on your savings? 0. What's your rate of return on Treasury bonds? Lock it up for 10 years, 70 basis points. So you're actually getting a negative rate of return right now. It's just that no one's told you. I mean, I'm telling you, but you're probably going to just brush this off. But you're going to see this at some point, because you're going to say, wait a second, my savings is actually losing purchasing power. What am I going to do? And the reason why the Fed is doing that, Brett, let me just make sure people understand this. There's a reason why the Fed is doing that, because the Fed needs you to pull that savings out and spend that money. If you keep your money in savings, what happens is you stall out the economy. So the Fed wants to incentivize you by stealing your money through inflation. It's a stealth tax. What they want to do is they want to incentivize you to pull that money out and invest it in something, or spend it, whatever you want to do. Stock market investment, private placement, go on a cruise, do something. You can't really go on a cruise right now, but you might be able to soon. So that stimulates the system, and it keeps the debt bubble growing. All right, so your rates are negative now, and a year from now, you're going to really see the average person is going to start figuring it out. But you can have advance notice, and you can make moves now. And this is what's happening. And remember that what they're trying to do is to get you to pump up the system, because they can't do it anymore.
So we've got another question asking, will the royalties come in production before the end of the cycle? And the way that we built this business over the last 4 years is that we wanted to have a different asset that came into production every single year for the next 4, 5, 6, 7 years. And I believe we have that today. A lot of our assets are being advanced, going into production. And what that's going to do is that's going to show increasing amount of growth and increasing amount of cash flow as the company moves forward, as the cycle matures. As EB stated, as the gold price goes up, we've got new mines coming on. Growth is the absolute hardest thing for royalty companies to have in bull markets. And so we've designed the company to have that growth built in, and we don't know how long it'll take for the cycle to mature, but we've got enough assets that'll come online kind of almost every single year for the next 4, 5, 6, 7 years that we feel that that's going to be able to drive a very big premium, because we're going to show a lot of growth when the other companies are struggling. I'm getting another question on NAV. I just took a quick look at the Scotia report. As of the end of September, when the stock price was a little bit higher than it is today, we were trading, or the consensus NAV was just about 2 times for our company. I would say today, as of the close, right around, I can't remember where we closed exactly, but I'd say we're probably about 1.8, 1.9, which is right about the average of the sector, which is, I think, a good valuation. But there's lots of room to the upside. You've got Franco over 3 times. And the other thing I think we'll see as this cycle matures is I think you're going to see the average, the royalty multiples of this whole sector increase very significantly as the bull market matures, just because there's going to be such high demand for these types of products that I think that the multiples are going to go much, much higher than we've ever seen in previous cycles. We got a question on COVID. COVID is a very kind of different thing that I think every business has had to deal with. How we deal with that is just diversification. We want to diversify from a jurisdiction, from an operator, as much as we can do from a diversification perspective is going to continue on. But I would say that our company was probably affected a little bit less from a material perspective than the rest of the sector, just given the bulk of our value was in development assets. Development assets are much easier to continue to move along, to continue to drill during this type of environment. And so, we still did see significant increase in the drilling. The value of the ounces that were reflected, I think, are going to show up after this year-end update. All the major mining companies normally put out a reserve and a resource update every year. Normally it comes kind of January, February, sometime in the first quarter. So we're expecting another big increase. Last year we had a big increase in reserves on a lot of the assets that we already own. And this is just straight to your pockets. All of these reserves that are increased, these are reserves that are on top of what was already accretive. And those reserves go straight to the NAV, and then that NAV is obviously multiplied by our multiple. So it can have a very material effect. And so we're looking forward to that again. We don't know exactly what the final numbers are, but, we estimate that, it's likely kind of upwards of almost $300 million likely spent on our projects by our operators in 2020. So, very, very good things to keep an eye on, and we'll update the market accordingly. Continuing on here. Yes, dividend reinvestment plan, at a point, we were looking to do the dividend reinvestment plan. That's still in the cards. We will wait, however, until we bring the dividend back, and yeah, so that will probably be in the future, and I know that it'll provide shareholders a bit more flexibility. We got a question on how much exposure to silver do we have, and right now, I believe that, Drew, this may be a better question for you, because we just updated, we're just working through the updates on the Higginsville transaction. Obviously, that's more weighted towards gold. But if I remember correctly from previously, we're kind of in the mid 30% range in regards to silver, according to our NAV.
Yeah, that's probably pretty accurate. I'd also add that we have 2 Pan American assets that are currently coming. I think they're online, but they're ramping up. And the primary driver of those royalties is clearly silver. We also have the new Luica silver stream that's currently producing cash flow for us. So we do have a meaningful silver exposure, particularly when you look at us relative to other royalty and streaming codes, maybe with the exception of Wheaton, which was silver Wheaton at one point. So they certainly got a head start on us, but we like our exposure to silver, and if we can add to it, we certainly will. We like that as a differentiator. I can get you a concrete answer offline if you contact Kristina.
Okay, perfect. We're just going to take probably 1 or 2 more. I know we've already gone over about 12 minutes. The questions are flowing in. They continue to flow in. So it looks like we do have a very interactive group of shareholders. So thank you. Thank you for asking all these questions. This is fantastic. I think this has just been an amazing turnout here. And I think it's very clear that we'll do this again, but we'll finish it up with a few last questions here. We've got one, do we anticipate going on the TSX? And the answer is no, because there's limitations on growth for the TSX that require you to get shareholder approval, where on the venture, you don't have those limitations. So as long as we're in this high growth phase of our business, we're going to continue to stay on the venture. We did, however, list on the New York Stock Exchange, which is the TSX times 10, or maybe even 20. And so that was our way to be able to bump the liquidity, get exposure to the capital, the global capital flows, which is extremely important in a bull market, because there's so much capital out there. A lot of public companies, especially on the TSX venture, forget, as a public company, you need to, as you grow the company, appeal and be able to, provide the largest amount of investors to be able to invest in your stock. And if you just stay on the TSX venture, it's actually a very small fraction of the investable capital that's out there. When you get on the New York Stock Exchange and your stock price is over $5 US a share, all of a sudden it opens up to about 90% of the investable capital for equities out there. So I think it's been a great thing for our company so far, and we'll continue on that path. Just going through the few last questions here. Got another gold price question for EB on when he sees $2,500 gold and $40 silver.
I know this sounds crazy, Brett, but I think we'll touch these levels by the end of the year. I don't know that we'll close the year over these levels, but I'm watching this market every day. This is the spot price and the future price, and all day. It goes all night long. And I'm telling you that this thing is going to break loose, and this is going to be one of the more powerful trades of my entire career. You know, been 15 years watching this thing and heavily active in the market. You know, I know just about everybody that's very involved in the gold market. I know people with, you know, tens of thousands of ounces in open positions in the futures market right now. I'm very, very connected to this business, and I'm completely convinced. The futures margin requirements all went up Friday. Short notice. I mean, you're just seeing the writings on the wall. I mean, all we need is a shock, and all you got to do is turn on the American news and say to yourself, do you think there's going to be something strange happen or no? I mean, it's just the firewood is all stacked up, and it's ready to go. So by the end of the year, I know it seems like a big number, but it's not that big really. I mean, gold can absolutely have that kind of year. So we're right on the cusp.
Well, Evie, you have been one of the most accurate, I think, if not the most accurate, you know, gold analyst and forecast here that I've seen, even much more accurate than almost all of the major banks. So, you know, we're happy as shareholders to be positioned. I mean, I could not pick another vehicle to be invested in. You know, I feel more comfortable with my with Metalla stock than I do cash in my bank account, which says a lot to be able to sleep at night. And I think that's a very difficult thing for any CEO to say. But it's literally the truth, and it's the truth in this environment. So it's important to be positioned, because oftentimes, particularly with the gold market, it's just historically always left everybody out of this trade. It is volatile. It will you know, if you trade with a lot of emotion, it's a very tough market. So it's best to pick a company that's going to continue to deliver, continue to give you more exposure to gold, have a great business. I mean, we can build just an amazing company with gold prices that just stay stagnant. So it just shows you that, you know, what we have built today, you know, if we do get these types of move in the gold price, I mean, you know, we obviously are not going to be going on record and you know, we can't go on record and say kind of what that will do to the stock price, but you know, it's going to be a very exciting time. And so, you know, I feel that the company is there. I mean, one of my biggest concerns when we started this company is, am I going to have enough time to build this portfolio to a stage where I am comfortable that we have enough to be able to give us that type of leverage and exposure? And I believe we've got it now. And as we enter this next phase, this kind of second phase life cycle of our business, and we scale this company up even further, it's going to be even more exciting. So stay tuned. Thank you all for joining our first ever webinar. We will definitely do this again. This has been amazing. We've had you know, hundreds of participants here, and tons of questions of investors engaging. So we're very excited and we're very pleased, and we'll look to get you guys an update here again probably in the next quarter. So thank you.
Before I conclude here, I just want to say, if your question wasn't answered, or if you have additional questions that come up, please feel free to reach out to us at info@metallaroyalty.com. Once again, thanks everyone for joining us today.
Thank you.
Thank you.